Greetings from our team at Rivera & Jones Wealth Management. This is Jack Jones, the managing partner, with our December monthly market update. Before I begin, I want to thank our valued clients for the trust and confidence that you place in us. The best part of our day is time spent directly serving you. And it was great seeing many of you this past Saturday at our curbside holiday event where we gave out tamales and margaritas. We had over 140 cars participate, and because of the generosity of you, our valued clients, we were able to donate hundreds of items to Mercy Ministry to support their food pantry, to serve others in our community during this time of year. So a lot of plate spinning. We'll kind of dive into a couple of recent items. FTX, we mentioned this in our last update, a crypto exchange that went bankrupt about a month ago. Interestingly, this is connected to Enron, which you may recall from 21 years ago as of December 2nd. The person in charge of FTX's bankruptcy is the same one that was in charge of Enron's bankruptcy. And so this quote has particular interesting color in that John Ray says he had never seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. So that says a lot, seeing as 21 years ago, he presided over the Enron bankruptcy. So we're still waiting to see kind of how the broader fallout from FTX's bankruptcy and how it affects crypto and other things. That's something to follow. So as it relates to markets, obviously been a volatile year. As of early this week, the S&P was around 4,000, down roughly 20% for the year, although off of its lows. So this was the low, was about 25%. We're sitting again in that 16 to 18% pullback as of year to date. There's always a reason to sell stocks. This kind of looks at the worst days, months, and then 3-month periods of time. September of 22 marking a particularly bad month. In other worse months, going back to 1950, on average, those months were down 11.5, and then on average, 1 year later, up 23. Now, interestingly enough, this month was followed by the best month in the Dow since 1976. With the Dow up double digits. And then November, while muted, markets were still broadly up, with the S&P and Dow being up roughly 5.5%. So now that we're nearing the end of the year, it's important to kind of look at what sectors have done well. We've maintained an energy overweight all year, and it's a good thing that we have up about 64%. And things like, services and technology are down considerably, with some names like Meta, Google, Microsoft being down 50% or more, names like Carvana down 90% for the year. So clearly a lot of kind of sector rotation from what did well in 2020 and 2021. So the Dow rallied a couple of weeks ago on this news, with the Dow going up 1,200 points. When inflation was still at almost a 40-year high, but the expectations were 7.9. So 7.7 is an improvement, and it's an improvement off of what marks the at present high of inflation of 9.1. The Fed's been active so far this year, 4 75 basis points rate hikes in a row, likely 50 basis points when they meet next week, but that's something we'll be carefully following. And again, inflation's at just under 8%, 7.7 as of the most recent reading. Now, to the extent that we do mark June as a peak inflation at 9.1, this looks at what happens in the next 12 months after peak inflation, going back to the present time, and kind of what the average returns are, or what the returns are after peak inflation over these periods of time. So the average stocks up 21 and bonds up 7. So the economy is also broadly slowing down. This is kind of the last 4 quarters of growth, ending 21 at +7, then going into 2 mild contractionary quarters. 2.9 was the final read on Q3, and we're waiting on Q4. Now, increasingly, there's a recession predicted. It's sometime in 2023. That's something that we're keeping a close eye on. Since the consumer drives 70% of the economy, it's important to see how they're faring. Their debt service ratio is up, and they're starting to draw down the excess cash. And to look at that excess cash drawn down in a little bit more detail, this from JP Morgan talks about that cumulative amount of cash, but that's on the decline now. It's forecast sometime in the mid to late 23 timeframe for that cash to be burned off that was accumulated during COVID. So to the extent that we do go into a recession this year, it's important to look at what happens before, during, and then 1 and 3 years after a recession. So kind of what this shows is 3 months before, on average, the markets are down. During, markets are actually slightly positive, and then 1 and 3 years after up. So kind of what a lot of what this tells you is that a lot of what happens in the markets happened before the recession actually begins. This is just expansion versus recession. On average, expansion 5 years, on average, contraction or recession. So the most recent jobs report, and this goes into the kind of good news is bad news scenario, was good. The unemployment rate stayed the same, but what a good jobs number means is that the Fed has more work to do to curb inflation. Ironically, the Fed would likely like to see this number be lower. So it means that they could either reduce the pace of raising interest rates, but a hot jobs market doesn't give them that opportunity. So this is just further kind of where unemployment rate is and kind of where it's come from. Although this morning, initial jobless claims, and this is December the 8th, rose to 230. That's the highest since September, and ongoing claims is the highest since January. So there are some signs of weakness that are developing in jobs, even though overall last employment report and unemployment rate are still strong. And this dynamic is still the case, which is there's on average 1.8 jobs open for every job seeker. And this is just to take a really long view. Now, this year has been bad, both in stocks and in bonds, and sometimes markets are negative. But going back to 26 to 21, on average, the return is 10.5%. And there's overwhelmingly more positive years, 71 versus 25 negative years. And the positive years are almost 2 to 1 the negative years. Now, it doesn't make any one of these 25 negative years feel good. But again, this just puts a almost 100-year time frame to give you some perspective on what we're going through in markets today. We will be rebalancing in the next week or two. We'll send out trade notes about that. We encourage you to contact us. None of this is an excuse or a replacement for how all of these things apply to you specifically. So please feel free to reach out. We're here to serve you if you have any questions about how any of this applies to you. And so with that, we'll wish you a Merry Christmas and Happy New Year. And again, thank you for the trust and confidence that you place in us. The very best part of our day is time spent with you. We again hope you and your families have a very Merry Christmas, and we look forward to seeing you at our forum in January. Take care.